Hi and welcome to this episode of Fairmont Rainmakers. I will talk today about property strategies. So, if you check online, you will see that you will have to spend a lot of money if you want to learn about property strategies, because every course is probably 5k, 3k, 10k. I mean, there are courses that are 20k. Probably 10 years ago, I went to some of them. They used to charge. I remember one course was like how to protect your assets. It was, I believe, 12k. Now, I think that, yeah, of course, if you have millions and you don't know how to protect your assets, then yeah, it's a very good deal to get a course, because if you know how to protect your assets, you will save a lot of money in taxes. You will save a lot of money in a lot of things. Also in suits, well, there are a lot of ways to save money legally, but especially inheritance tax is quite a lot. But if you know how to do it, then you can save money. But at the same time, it is possible to learn that spending less than 12k. I mean, you just need to know, you just need to get a good lawyer, really, to set up the structure for you. You need to spend in lawyers, but you just need to contact a good lawyer, and then they will advise you, and they will do it for you. So that's it. I mean, imagine you instead of spending 10k, I just gave you some advice, and if you put it in practice, you can protect your assets. So in the same way, I will just go over the property strategies, and I will give you a summary of some of them. Okay, one thing is to learn things, and something very different is to apply what you learn. Okay, talk is cheap. And execution is everything. So you need to execute. Okay, you can know about all the strategies, but if you don't execute, you won't learn. But with investments, when you execute, you need to be smart. You need to do a lot of due diligence, and you really need to focus on the money. Okay, you need to know finance. So you need to know how money works. Okay, there are strategies that sound amazing, like property development. It sounds like get rich, not quick, but a strategy that will make you rich. But in reality, if you look at deals, if you look at lots of, I have seen hundreds, probably over 1,000 property development deals, and there are lots of deals that just don't work. I mean, there's a saying, that dog don't hunt. So there are lots of deals that are like that. Not only property developments, you get a lot of below market value, even lease options. You have a lot of rent-to-rent deals that don't work. You have a lot of delayed completions that even being delayed completions, they don't work. But with developments is quite interesting, because I have seen deals that where the land or the building is being sold next to nothing, and the deal is not working. It's crazy. And you need to know how developments work, how the costs work, to realize that a lot of deals just don't work. Okay, a lot of vendors, they're just looking for someone with a lot of money that really is not looking for a profit. Okay, they just want to sell it to someone that is not looking to make a profit from the deal. So it is very different. I believe I talked about this in the last episode a bit. It is very different to be someone that is selling real estate to people that will live in the house, than someone that is a property sourcer that is selling deals to someone that wants to make a profit. Okay, in the same in developments, there are deals where you can buy the deal, build the house, live in it, and the deal looks nice, because nice is a word that you can only use if the person that is getting the deal will live in it. Okay, if you want to buy land to build your house, then you want to be in a nice place, you want the house to be nice and everything. But if you are looking for an investment, you are not looking for something nice. You are looking for a profitable deal. Okay, so that's very important to know. So first, I will just tell you about the strategies that I will talk about. I will just give a summary, because there are a lot of property strategies, and these are not even all the strategies. There are more. Okay, but I will just tell you about all of them. Delayed completions, that's one. I will talk about lease options, below market value deals, HMOs, which are houses in multiple occupation, service apartments. Now, HMOs and service apartments, you can get them in two ways. Okay, one, you can get a HMOs by getting deals on a rent-to-rent basis, or you can buy the HMOs. I prefer, and I think that is better to buy the assets, because you get capital growth, and you also get the cash flow. So buying is better. Okay, however, to buy, yes, you need more money. So rent-to-rent is another option. You get cash flow, but you don't get any capital growth, and is different. You have less control of the deal with rent-to-rent. Then you have property sourcing, property developments. In property developments, you have different strategies as well. You have build to sell. Then you have build to rent. You have PD, which is permitted development deals. You have commercial conversions. And then you have planning gain, okay, where you get a land or a building without planning. You exchange subject to planning. You go to the council, apply for planning, and then build the deal yourself, or you can sell it to an investor or to a developer, and you make profit in that way. Then you have co-living deals, buy, refurb, and refinance, and then you have title splits. Okay, so these are not all the strategies, but there are quite a lot. Okay, so I will just give a summary of all of them. We do teach all these strategies kind of more in detail. However, as we say, talk is cheap, execution is everything. I think that you should only learn about a strategy if you will apply it, or if you will do deals. Okay, what's the value really in just knowing something? Okay, like just think about it. If you just know and you don't apply, what's the value? What's really the value of that? And then think about how many things you know and don't apply. So let's start. Okay, now you have the first one, delayed completions. Okay, with delayed completions you can make a lot of money. Okay, so a delayed completion is where you tell a vendor, usually you use this in developments. There is I have got deals, source deals, delayed completion deals. So I know how the process works. Oh, you also have joint ventures, actually, joint ventures with landowners. So with delayed completions, you go to the vendor and you tell the vendor, okay, the price of this land is $1 million. It has planning. Well, this is a real deal. We got a delayed completion. The planning was for 12 houses, but it had planning already. Usually in developments, the price of the land should be 1/3 of the gross development value of the development. The building costs should be another third of the gross development value, and then you have buy and sell costs. That's usually 20% or around that of the value of the land plus the building costs. So you take that into consideration, and you should make a profit of minimum 20%. Yeah, preferably on the gross development value, but when there are not a lot of deals, developers can be okay with making 20% on the costs of the development. Okay, so on the delayed completion, what you do is that you tell the landowner, okay, the price is $1 million. I give you now 100,000, and this is the deal that we did, that we sourced for a developer. So the deal was $1 million. The developer had to put 100K, and then in 18 months pay the balance from the sales proceeds. So when the apartments sell, you pay the landlord, the vendor. Sorry, you pay the vendor the $1 million, but then you need to give them an uplift, usually, because you need to motivate them in some way. Okay, when you are doing deals with vendors, with landlords, with everyone, you need to think about. I mean, everyone like this kind of experience in property knows that you need to know what they want. So you need to find out what are they looking for. What's their motivation? Where is the pain? What's the thing that they want to get rid of? Okay, so if you add value to them, you take out the headache from them, then you get a deal. Okay, now to do that is, well, it depends of the vendor. It can be easy, it can be difficult, but if you get a good deal, is worth it. However, if you are looking to get into property and do deals, you need to be realistic. Okay, you should start, I mean, in everything in life you need to start. I mean, if you're starting from scratch, you need to start small. If you are in the middle, then you shouldn't go into massive deals. You should do the small deals as well, and then just scale after. Just remember, always focus on the money. Okay, I see a lot of there's a lot of people in property. It looks like they are rich. Okay, it looks like they have a lot of money, that they have a lot of deals, they are building, and they are doing a lot. But you need to look at the finance. You need to look at the money. Okay, it's not great. I mean, you need to look at the cash. You need to look at the cash flow. You need to look at the reality of everyone, really. So if you're looking to do a development deal, you should have money. Okay, you need to have a lot of money, a lot of cash, and you shouldn't invest more than you remember. Never over leverage yourself. So I would say, if you have $1 million in cash, if you put 500K in the development deal, that this is a good deal, then that's fine. Okay, but you shouldn't put more than that. Okay, I think that usually a good strategy is to invest 40% or probably 50% of your cash into deals, into investments, into things that will increase your your income, and then you should always keep cash, like 40%, 30% cash is good, and then 20% you should spend. Now it depends of your income, it depends how much money you make, but always you need to save a percentage of your income. Okay, so then we have joint ventures. In a joint venture, you go to the landowner, you tell the landowner, okay, the land costs $1 million, I will do everything, so I will get the builders, I will raise the finance for the building costs. Now, what people do, a lot of landowners, they don't know that you can raise 100% of the building costs for any deal. A lot of people don't know that, so they think. I mean, there are developers that tell the landowners, "Oh, I will get the finance for the building costs. You put the land into the deal. I will put the finance for the building costs, and then we can split the profits 50-50 or 40-60 or 25-75. I mean, it depends of the landowner. So in that way, people say that you can do a deal without money down, but in reality, you need to have experience to do development like that. So you need to joint venture in two ways. If you don't have experience, you need to joint venture with a developer, and you need to joint venture with a landowner. So you need two joint ventures, okay? And the land should have planning, okay, to do a joint venture deal. If there is no planning in the land, then that's subject to planning deal. So I will talk about that in the next few minutes. First, I go to the next strategy. So we have lease options. Okay, lease options, they look great. Okay, a lease option is a strategy where you have two contracts with a land owner or with a property owner. Okay, so for example, if there is a property that costs 100,000, okay, that's the value of the property. Okay, and the rent, let's say, is tenanted, and the tenants are paying $500 a month. Okay, now the mortgage of the owner is $400 a month. Okay, so the price of the property is $100K. His mortgage is, let's say, £300 a month, and the property is rented for £500 a month. Okay, so if you go to this owner and you tell the owner, look, let's say the owner is tired of dealing with tenants, he doesn't want to know about his property anymore, maybe he's a doctor working overseas and he just doesn't want to deal with the property anymore, he just wants to pay his mortgage and forget about the property. You will tell the owner, look, I will manage the property, I will just pay you £300 guaranteed, and then for 5 years or for 10 years. Okay, so that's a lease option has two parts. One is the lease and the other is the option. In the lease, you have a lease contract with the owner where you pay £300 a month during 1 year, so that's £3,600 a year, and with that money he will pay his mortgage. Then you collect the rent from the tenants. If it's £500 a month, then you collect that and you keep 200. So you make £200 a month profit. And if you have problems in the property, if you have management problems, and like you need to deal with that, because the landlord is just getting a guaranteed lease payment because they don't want to know about the property. Now, the second part of the lease option is the option contract. In the option contract, you tell the landlord, I want to have the option to buy your property for 100,000 within 5 or within 10 years. Okay, so then you will have the option to buy the property at any time during the 10 years for 100,000. On top of that, if you have this contract, you can also sell the property. Okay, you can sell the property because you have the option to buy the property for 100,000. So you can buy it yourself if you want, or you can sell it to someone else. You need a lawyer to do all these strategies. Well, you need lawyers to do all these strategies because you need to make sure that the contracts are right. You need to make sure that everything is going according to what is in the contract. Okay, there are some strategies that are a lot easier, where you really don't need a lawyer to exchange, to complete, to read all the contracts. I mean, lease option contracts are easier, so you shouldn't pay that much to get a lawyer to review one of those. But if you are doing developments, then yeah, you will definitely have to pay a lawyer quite a lot to make sure that the contracts are right. So with the option contract, yeah, you need to get a lawyer, and you need to make sure that you have an assignable contract so that you can also sell the property to someone else. If the property goes up in value and the property, let's say in 5 years, is worth 120k, then you make 20k. Okay, because you have the option for 100k, but now the price is 120k. Okay, now there is people that teach that. I remember this is a different company, probably 8 years ago. The same, they were selling. I mean, there are some good training companies in property, I think, but I mean, some of the strategies to learn some of the strategies is just so expensive. I think that the prices are very high, really. Like, imagine lease options. There was a company, they used to do events. Probably they still do events, I don't know. But they don't have a lot of experience in property. They just sell training. You need to check when you are kind of learning from companies. You need to check if they know how to do the strategies that they are showing. Okay, in this option, this company was charging 15k to teach you how to get lease options. Now, if you have experience, you will know that it's not easy to get lease options. I mean, you will never get a lease option in London for £1. Okay, if someone is telling you that you will get a lease option in London for £1, they are just talking shit to you. That is just not gonna happen. Like, you can. It's so difficult. Why? Because you need to be logic. Okay. In London, there are private equity companies that have millions in the bank, and they are just looking for deals. So the competition will crash you. Like, they will just buy the good deals straight away. Okay, they will just buy them in cash. Okay, that's actually for developments, but the same with houses. I mean, in London, there is so much money. Like, if there is a landlord that let's say is open to a lease option, okay, the landlord will say, okay, I want £40,000 as a deposit. Those deals you can find for sure. £40,000 deposit, and then the balance you can pay within 10 years. So you can get the option, okay? But with the option contract, the difference is the deposit. So it is possible to get a lease option for £1. So if you see, there are a lot of training that is teaching you how to buy a house for £1 or $1. It is possible to do it, but the house that you are going to buy for $1 or for £1 won't be amazing. So it will be probably a shed house, or either in bad condition or just not in a good location. However, you can get decent deals just exchanging with £1 or getting an option contract with £1 deposit. Now you need to pay £1 or $1 deposit because for the contract to be legal, there has to be money involved, and the minimum legal requirement is £1 or $1. Okay, so that's why you need to pay at least £1 or $1. The same with development deals. You have to pay $1 or £1 as a minimum, but it's very, very difficult to find a deal where the landowner or the building owner will let you put £1 or $1 and then to pay the balance many years later. So it is difficult to get good lease options. You can get lease options, definitely. You can find some lease options, but then the factors that you need to take into consideration are the deposit and the quality of the property. Okay, so you need a good deal. You need a good property. Don't get a property that is in very bad condition, because then you are responsible for the repairs as well. So you don't want to get into a deal where you will have problems long term. Now, on a lease option, you get the option to buy the property for $100,000, but that value won't go down with time. Okay, so, and the deposit, yes, you can get a deal for £1, but usually the landlords want some money. Okay, maybe sometimes they don't want that much, maybe $1,000, $2,000, it depends, but you need to negotiate that. Okay, and you need to, usually when you get good deals is when you don't have that much competition. Okay, I will talk about that a bit when I talk about subject to planning deals, commercial conversions, and property developments. Now, a better deal than lease options are installment contracts. On an installment contract, you buy a property without a mortgage and without a bank. So, well, it's similar than banks. Okay, when you get a mortgage with a bank, you can pay capital plus interest, or you can pay interest only. Okay, if you pay interest only, you're only paying the interest, and you never pay the capital. So if you owe 100k in the first year, in 10 years you will still owe 100k. If you pay capital plus interest, then you owe 100k in the first year, but well, it depends. Let's say you have a 30 years mortgage. In 30 years you don't owe anything. So it is better to get installment contracts, and it is better to buy properties with low with capital with capital payments. So you need to pay capital plus interest. You don't want to pay interest only. You want to pay capital and interest. So why do you want to do that? There is people, I don't know, I heard before people saying that it's not good to pay capital and interest, but you need to think that you need to realize that in the world there are crises. Okay, now, well, recently we had well, the pandemic, and before we had the crisis in 2008. So 2008 was worst because a lot of banks called the loans because that was a financial crisis. Okay, the crisis that happened on this year 2020 is a pandemic, so it's different. So in the same way, we have option contracts and installment contracts. An option contract is the same or is similar to an interest-only mortgage, and an installment contract it's similar than interest plus capital mortgage. Okay, so at the end of an installment contract, you will own the property. Okay, so these are the best deals. Okay, and I don't know why some people don't. I think people just don't know about it. People don't know that an installment contract, you can own the property. I mean, if a deal goes wrong, if you have a lease option deal and the deal goes wrong, then at the end of the deal, you won't make any money. I mean, you won't own the property. However, if you have an installment contract and let's say the deal goes wrong, you lose cash flow, and then you get, let's say, 2K into debt because of the deal. If you had a lease option deal and you are 2K in debt, then you need to wait until the cash flow makes you recover those 2K. But if you have an installment contract and you get 2K in debt, you will feel more better because you have equity on the house or on the property. So yeah, I will always recommend to do installment contract deals, or well, and if you are getting mortgages, to pay capital plus interest. Imagine if there is a crash and real estate goes down 50%. Nobody wants to think that, but if you learn from like billionaires, okay, you will realize a lot of things. Warren Buffett says that if you are an investor and you are not prepared for your investment to go down 50% at some point, then you are not really an investor. Okay, if you are an investor, you should be prepared for everything to go down 50%. And if that happens, you are fine. If you have 75%, if you owe 75% of the value of a property to the bank, and there is a crash and property prices or real estate goes down 50%, banks can say, okay, we will call the loans and you need to pay me the difference. You need to pay me 25% because you owe the same. Okay, the banks won't tell you, oh, okay, so the prices went down 50%, but it's not your fault, so we will forgive you, and you just need to give us 50%. You just need to give us the property, and we will sell it, and don't worry about the 25%. No, they won't do that. They will tell you, well, they will send you to court, and they can make you bankrupt if necessary. Well, if you lived in 2008 and you were in property during those days, then you will know that's the case. If you are new and you don't know, then yeah, you should do some research about 2008 and about how so many people lost massive property portfolios and real estate in 2008. How did they lose everything? That's a very good thing to know. So moving on to the next one, you have below market value deals. Below market value deals, that's easy to explain. You get a property that costs 100,000, so that's the market value of the property. If you negotiate with the owner and you manage to get the price down 20%, you buy the property for 80,000, and then you can refinance the property. If you use a mortgage, you can refinance in 6 months, and then when you refinance, the value of the property will be 100K, so you can take most of your money back. Then you have houses in multiple occupation. Those are houses where the property probably has 3 rooms, but it has 2 reception rooms and it has a big kitchen. You can convert that property that is a single let into a house in multiple occupation, and then you can rent the property on a room by room basis. You can do this in 2 ways. One, with a rent to rent contract, so you are renting the property from the landlord. Let's say the rental price is 1,500. You do some renovations and you rent it for 2,500 or 3,000. You can make about 1,000 profit. Now, it is better to buy the property because then you are the landlord, you have control of the property, and you can do whatever you want with the property. But it is very important to know about legislation. So you need a HMO license if you want to use this strategy. So you need to know the regulations, and the thing is that the regulations are different in different areas. So you need to know the regulations in the area where you want to run your house in multiple occupation. Then you have service apartments. Service apartments, the same thing. You can get a service apartment on a rent to rent basis, or you can get it just buying a property. So in houses on multiple occupation, you rent the property on a room by room basis, so that's why the value of the property increases. On a service apartment, you rent the property on a daily basis, and that's why their revenue increases as well. So in the same way, let's say on a single let, you can achieve 1,200 on a property. If you use the HMO strategy or SA strategy, you can achieve probably 2,500, but then you have expenses, so you can make a profit of 1,000. You can make more. There are properties that I have seen, they can make 2,000 a month. So it depends on the deal. You need to get a good deal. You need to check the area, and you need to negotiate with the vendors or with the landlords. Then another strategy is property sourcing. Property sourcing is basically just finding deals and doing due diligence on the deals, and then selling the deals to private investors. Okay, if you are good at that, you can make a lot of money. And if you are really good at that, then you will realize that instead of only selling deals, you should you can just take the deals yourself, because in property the money is in finding deals. That's where the money is. Okay, not only finding deals, but structuring deals and finding great deals. Okay, some people say, well, if you find great deals, the money will come to you, but that's not the case. Okay, if you find great deals, the money won't go to you unless you have a network of investors, and unless you have a network of professional people that know how to act fast, and that know where the money is. Okay, in property, you need to get deals that add where you can add value in any level. Okay, if you are doing rent to rent, or if you are doing lease options, I mean, in any level you need to add value to the property, and that's how you make money. So If you're in property sourcing, you need to get good deals. You need to get good returns to the investors, and you should take deals yourself, really. So it's a very good strategy to build cash, because you just sell the deals, but you don't generate capital growth, and you don't generate cash flow. So then you need to combine this strategy with another one. A better strategy, as I said, than rent to rent is just buying properties, and in the same way, instead of just buying and renting on a single let, it's better to use service apartments or HMOs. Okay, that's why our franchise, we work with investors, and they buy the properties, and we rent them on a HMO basis or on a SA basis. Okay, because we want to increase the value of the properties. Then you have property developments. In property developments, you have the same many strategies. Okay, you have build to sell, is where you get a deal, you build let's say 10 apartments, you sell everything, and you make 20% profit, or 25% profit, or 30% profit. In developments, you should look for 30%. You will realize that it's very difficult to get deals that are with a 30% profit with planning. Okay, if you find deals without planning, then 30% profit is a lot easier. Because there's something called the planning gain. Okay, and the planning gain is where you find land with potential to develop 10 apartments. It's very different to find land with planning permission for 10 apartments and to find land without planning permission for 10 apartments. If you find land with planning permission for 10 apartments, the value of the land will be probably $1 million. Okay, so let's say there are two vendors, they have land in next to each other. One land has planning, the other land there is no planning on the other land. The land owner with the land with planning will sell, or will try to sell that land for $1 million, and the owner with the land without planning can be open to sell it for $500K. Okay. Now, also on that, well, in every deal in property, the best deals are off market. Okay, off market is not because you don't want people to know. I mean, for example, there are vendors selling mansions where they want the mansion to be off the market because they don't want people to know that they are selling the mansion. Okay, so that's one kind of sellers. Okay, but those are not the reasons why off-market deals are good. Okay, off-market deals are good because what an off-market deal means is that the deal is not on the market, like that the vendor doesn't want to sell the deal. Okay, so it's like you going to your neighbor and telling your neighbor, let's say your neighbor has a house that has potential for a loft and add value at the back of the property. Then you go to your neighbor and you tell your neighbor, well, your house is quite nice, I want to make an offer, I want to buy your house. The vendor may say no, or the vendor may say, oh yeah, well, I'm open to sell it. If your neighbor says, I'm open to sell the house, then you can take that deal, well, and do it yourself, or you can sell that. Okay, and that's a good deal. That's an off-market deal. Nobody knows that your neighbor wants to sell, is open to sell the house, and nobody will know. However, you need to be careful as well with off-market deals. If you have developers that are interested, or anyone really that is interested, you need to have NDA, so non-circumvention and non-disclosure agreement. And after that's signed, then you can present the deals to investors, or you can do the deal yourself. So you have a build to rent is where you get a land, you build the 10 apartments, then you refinance the whole development, and then you rent all the apartments to just private tenants. Now, if you have 30% profit on the gross development value, you can build something and then take all your money out of the deal. For example, if you find land for $1 million, build for another $1 million, and then you have building costs plus the value of the land are $2 million. Then you have buy and sell costs, 20% of that, so that's $400,000. If the value of the development is $3 million, then you make $600,000 on profit. If you sell the development, then you make $600,000. But if you refinance the development, then you can get 75% of the $3 million from the bank. Okay. So with this example, you will get 2.25 million, okay, from the bank. 2.25 million from the bank. You invested 2.4 million, so you will have 150,000 in the deal, but you will own all the apartments, okay, and they can go up in value, and you will have the monthly income from the rents as well. You will have a mortgage of 2.25 million, but you will still make profit doing these kind of deals. However, a property development takes time, and the bigger the deal, the longer it takes. A big deal will take 3, 4, 5 years. So if you want to get into property development, you need to have a lot of cash, and you really need to think about the cash. You really need to think about the finances of the deal, and you need to have a lot of cash reserves. I like to study big companies when I learn about strategies. So one of the biggest property development companies in the world are called Related. Now they went through the 2008 crisis, but the only reason why they didn't go bankrupt was because they had a lot of cash reserves. Okay, if you're a developer and something like 2008 happens and you don't have a lot of cash, you will have problems. So that's why you need to think about the cash. Okay, this is why at Fairmont we tell and we train in cash. Okay, so all our franchisees know that you need to think about all the financial aspects of a deal when you are doing a deal. You need to think about everything, and then when you think about everything, you still need to have a safety margin, a margin of safety. So you always need to think about what can go wrong with the deal. Then you have permitted development. So there are commercial buildings that can be converted into residential buildings, which is the same as commercial conversion. So there are commercial buildings that can be converted into residential buildings without having to apply for planning in the same way that you have to apply for planning for just land. Okay, so you can find commercial conversions. A lot of those deals are overpriced because, I mean, building owners, they know. I mean, especially if they are dealing with a professional agent, they know that a commercial conversion can be converted into that a commercial building can be converted into a residential building without having to apply for planning in the same way that you have to apply for planning if it's just a land. Okay, so state agents that sell land and buildings, they are more they know more about the deals than state agents that are selling houses. I mean, state agent that is selling houses, they know about the house, but they know that their clients, they don't want to know how profitable the house can be. They just want to know the closest stations. They want to know where is the nearest coffee shop. They want to know different things than investors. Okay, so when you are dealing with agents and with real estate agents that sell developments, they will know a lot about the deals. Okay, they will know if they are big firms. They will know building costs. They will have a lot of details about the deals. Okay, and that's why they will have a lot of leads as well. And they usually, some of them do a bidding war, so they have a lot of people bidding in the deal, and they will just present all the offers to the vendor and get the best offer for the vendor. So you will have a lot of competition. Those deals are not off market. Some of those deals are good. You can make a lot of money on those, but you cannot be that creative because you have brokers in the middle. And some brokers know about creative strategies, but not all of them. And some of them won't even talk to the vendors about creative strategies. So you can get deals from brokers, but it is always better, not only in property but only in businesses, to go direct to the vendors, direct to the landlords, or direct to the business owners. Okay, I won't talk about business buying in this podcast, in this episode, but yeah, in any deal, when you go direct to the owner, you will get a better deal. Talking about this, if you read the book The Art of the Deal, you will know that when Trump built Trump Tower, he traveled to Europe to meet one of the vendors. I believe he met the guy that owned Tiffany and Co. Building, and then he did a handshake deal with that guy, and then he realized that at that point, because Trump before he used to deal with flats and apartments in bad areas. So when he did a deal with some of his previous tenants, just a handshake deal, they never they never followed through with the deal. However, when he did a deal with this guy, the guy did exactly what he said he was going to do. Okay, he had more offers and everything, but he kept his promise to Trump. And well, he built the Trump Tower. but yeah, it's a very good book. So it's if you like to read, you should read that book. Is one of the best books that you can read if you are in property or real estate. Okay, so then we have co-living. Co-living is where you take a bit, well, the same. It's usually with land, because in the same way that you have HMOs, which are just houses in multiple occupation, co-living is the same, but it's just bigger. So instead of buying a house and turning 3 rooms into 6 rooms, with a co-living scheme, you buy land and you build 50 rooms or 100 rooms in the land. So you just develop a building with 100 rooms there, you rent the rooms, and in the same way you need to work with a minimum of 30% profit on gross development value. On co-living, well, and in any deal, yeah, always remember the cash. Okay, always think about worst case scenarios and never over leverage yourself. Then we have buy, refurbishment and refinance. Okay, so this is when you buy a property that is in bad condition. You buy it cheap because the property is in bad condition. Then you do works in the property, so you do a lot of building works, and then you add value to the property. For example, if you buy a property for 100,000, this is just an example. These numbers are not real, okay? But just as an example, you can buy a property for 100,000. You invest 30k, and then let's say that now, after you buy the property for 100 and put 30k in, the value of the property is 200k. Okay, so you put in 130,000, and if the value of the property is 200k, you can refinance the property for 75%, so 150k. So you take 150k back. Okay, in this example you make profit of 20k, but it's just an example. Usually you don't even take all your investment back. However, you can get deals where you take most of your money out of the deal. There are deals that will let you take all your money out of the deal, but it is more difficult to get those deals. And then you have title split. Title split, let's say there is a house that can be split into 2. Okay, now the value of the house without splitting the house into 2, let's say, is 200,000. But then if you apply for planning, they grant the planning, and then you can now split the house into 2. You can sell each house for, let's say, 150k. So now you have 2 houses. The value of the 2 houses is 300k, and you made 100k profit. The same is not a real example, but that's how the strategy works. Well, I went over these strategies. There are more strategies. However, thanks for listening, and I just want to say, if a deal looks very, very good, it's difficult to get it. Okay, so the best deals are difficult to get. The deals that are easy to get are more realistic. Okay, so if someone is telling you that the deal that it's possible to do great deals and it's very easy, that's not true. Okay, it's difficult to get great deals. Okay, it's difficult, but it's possible. So, okay, thanks for listening, and we will see you in the next episode.